Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome once again to Money Sense. Your hosts this morning are Christoph Barnett, Neville Hicks and myself, Simon Cordery. I'm delighted to be joined in the studio this morning by Raoul Pal. Raoul is the co-founder of Real Vision and the author of Global Macro Investor, which is a newsletter written for investors. Raoul is also the former manager of a macro fund for a large UK hedge fund, GLG. So Raoul, thank you very much for joining us this morning.
Thanks very much, Simon.
Perhaps before we go into an analysis of what's going on in the world, just explain to us what Real Vision is, because there may be a number of people listening to this who often want to get more financial information, and that's kind of what Real Vision is about, right?
That's right. We're essentially the Netflix of finance. We started the world's first video-on-demand platform for finance. We interview many of the world's most famous and sophisticated investors, but allow people access to it at a price that's reasonable. So people can educate themselves by seeing how the true experts invest. And that's been a great thing. We've built the business here in Cayman, and we've got customers in 120 countries worldwide, and we're growing every day.
Excellent. So people can just go online and watch videos of recognised experts as and when they want to, basically.
That's right. There's a free trial, so you can just go to www.realvisiontv.com, sign up for a free trial and have a look around.
Fabulous.
No obligation.
Fabulous. Well, let's sort of take that analysis and say, okay, well, people can go on to that, but we're gonna grill you this morning as to what your thoughts are on what's going on in the world. So you very kindly sent me a copy of your recent newsletter, which was somewhat sceptical in its view of where the world was going to be, I thought, in that you were nervous about certain events that are happening. You had written it post-Brexit, and we've talked a little bit on this show about Brexit, about the implications that might have for the global economy, leading out of the UK, then following into Europe. So where do you see currencies going now that the Brexit vote has happened, that markets have settled down? It seems as though investors have looked at Brexit and said, oh, disaster. A week or so later, they said everything's fine. Currencies, markets, what's your take on where things should be and where things are going now?
I think we need to look at isolating different markets to understand what's giving you signal, what's giving you noise. So equity markets are doing one thing. So the stock markets in the US are at all-time highs, and that's something to do with the fact that the business cycle is still relatively robust and things are relatively okay, and the central banks may be helping stimulate things further. But we look at the bond markets, and yields fell a lot after Brexit as people have rushed into yielding instruments. Then we've got the currency markets that have moved and continue to move. And there's something big underlying going on. Before Brexit started, about a year or two ago it started, which was the dollar started going up. So people here in Cayman will have noticed that they can buy things from abroad, maybe a little bit cheaper. And, it's relatively expensive here as it is, so it's a nice thing to see things from abroad being cheaper. And that's because the US dollar's been going up in value. So after Brexit, you've created another point where we don't really understand what the outcomes are, so it makes people a little bit nervous. And the US dollar is a relative safe haven. It's attracting money into the US. The US stock market's at all-time highs. European stock markets aren't.
So that's something I don't quite understand. You touched upon it. You said that after Brexit, when there was a degree of panic and concern, investors bought a lot of bonds, which is typically a signal that they're worried about something. And then at the same time, confusingly, investors bought a lot of equities, which is typically a signal that they're optimistic about something. How can we reconcile those two factors?
Yeah, this is an interesting thing. Usually you would say, and as you're kind of suggesting, somebody's wrong here. Who's bought the wrong thing? Yeah. Who's going to lose some money here? So it depends over what time horizon. So I think currently there's a period of growth that's a burst of growth, call it that, for a couple of quarters that's in the US right now. And that may cause bond yields to rise a bit as people start to become more optimistic and have moved into equities. But this divergence is interesting, and I think it's being caused by two different sets of people. There's one set of buyers who are forced to buy bonds, and the lower bond yields fall, the more bonds they have to buy. And that's generally the life assurance companies, the pension plans, and everybody else. On the other hand, there's the buyers of equities who are buying because bond yields are so low, they need some yields, and equities have some yields, although they're much more dangerous and volatile.
And that's related to, I presume you're saying that the buyers of equities, not all of them, but a significant proportion of people who are buying equities are in effect being forced into it by central bank policy around the world, who have forced bond yields to, in many cases, zero or negative levels.
Look, this is one of the most important themes out there, and it's not just for those of us in the financial markets, it's for every man. They have to understand that because of what central banks are doing to try and support the global economy, because it's very fragile, the financial system around the world, is still not good in many countries. So the central banks have been manipulating things, pushing bond yields lower. In many countries, they've been buying equity markets to drive equities higher, to make people feel like it's going to be okay, to try and support people's pensions and stuff like that. But the problem is if you're being forced to buy equities at all-time high valuations, barring the late burst in 2000, the propensity to lose money over time is very high. So in which case, it's not a clever thing to do.
In principle, do you think equities are the person who's listening to this show will be thinking, look, really I can go out and I can buy equities or I can buy bonds. Other asset classes are a little bit more complicated to acquire sometimes. Do you think that people should be buying equities at this particular juncture because they're at all-time highs and because the buyers of them have been forced into it? Or are we in for a potentially worrying reversal or downward movement in equities?
If we're assuming people aren't day traders here, so people are looking at their investments longer term. So in which case, this is exactly the wrong price to own equities, and over the long run, bonds will not do very well, and there's no yield in bonds. So you have to face the realities of the situation. So what are the realities? Is pension funds are facing the same problem around the world right now, and the allocation ends up becoming real estate for a period of time, because real estate has a long duration, like equities and bonds, and you get a yield. So, REITs in the US, they're interesting because over time they have a yield.
Let's just sort of, sorry, just to interrupt, let's just explain what a REIT is to people, because we use a lot of terminology on this show, and I want to try and make sure that we explain what those terminologies are. So perhaps you could just...
Yeah, it's a real estate investment trust, and basically what it is, it's a share that allows you to buy a share of a portfolio of real estate. So it just trades like a share, but it's on real estate.
Touching a little bit more on the on the central bank theme and printing money and supporting, which really has been largely the equity market. When does the music stop?
What's interesting, so on Real Vision we have, some of the smartest people in the world, and almost everybody points out this problem of central bank hubris, where central banks think they can control things. The reality is central banks have been around for 400 odd years, started in Holland or Sweden, and they've got no smarter. People haven't got miraculously smarter. There's no some genetic miracle that's gone on. Nobody's figured out how to manage the business cycle, so they should allow it to happen, but they don't. So they try and manipulate it. And everybody on Real Vision has noticed that this is going too far. We don't know when it's going to stop or what that means. But there's a problem, and the problem is debt has been built up on the other side of this, and it's the debt bubble that came out of the 80s, 90s, and 2000s that is the problematic issue here.
Let's just touch on that debt question, because you suggested that equities are expensive for a long-term investor, and if they're 10, 15% cheaper at one point in the not-too-distant future, that might be a more attractive entry point. Bonds aren't going to deliver a lot of return. So you alluded to, well, perhaps real estate is an opportunity. A lot of people remember, with not very fond memories, some of the recent challenges that the real estate industry has created for the global economy in terms of people overburdening themselves with debt, going out buying lots of property and finding that wasn't quite as safe as they thought it was. Why is this time different in that respect?
It's because, and again, this is not the world's perfect answer, it's because a lot of people are going to have to own real estate because it does create a yield. And there is less, if it's done without debt, then it's fine. The problem is the excess leverage. So I'm not saying people should go out, borrow more money and buy real estate. What we're saying is the real estate investment trusts, which trade like shares.
More liquid.
Most of them don't have any leverage in. So that's fine. You're just getting a share of a portfolio of real estate. That kind of makes sense to me. And it's the leverage that's not there.
Let me drill down a little bit further on that, because one of the, and I want to talk with you perhaps after the break a little bit about the political situation in the world and what that might mean for equities and investors. But one of the overriding perspectives, it seems to me, is that people are complaining about too much immigration in countries, whether it be the US, whether it be the UK, some parts of Europe, even here in Cayman. And yet, real estate is a function of supply and demand like everything else. And if you take away some of the demand by reducing the number of people in countries, doesn't that have a potential negative impact on the real estate market? Because you take away those people who are going to be buying or needing to rent those real estate units.
Yes, that's right. There is an argument, obviously, that some people make, and to say, in England, you'll hear the argument all the time, is, well, if there was less people coming into the country, then the price of real estate would be more affordable for others. But generally, real estate's not pushed from the bottom up by the low entrants pushing it up, which most of the immigrant population is actually pulled from above. So it depends how that is. Now, I think it is problematic if you bring in less people for that issue. Is, particularly here in Cayman, it's a small country. So that can create some dislocations in property markets, and we'll see it, I think, the same in the UK. Everyone gets very nervous of who the buyer is, who the new buyer of property is.
Yeah, you don't want to be the last person to buy something before the new buyers walk away. You've got to be able to sell it to someone else.
Yeah, and look, these things aren't easy. So there's a big buy-to-let market in the UK. So a lot of those people are renting small apartments out. Too many of the people will be the immigrant population. And that's the average middle-class guy has gone to this to try and support his pension.
And that's similar in Cayman, right? So you've got a lot of people who buy $200,000-$300,000 properties, rent it out to expats who are starting out their career perhaps in the Cayman Islands, and a similar sort of risk if immigration becomes a topic of concern.
Well, if you're getting rid of immigration at all levels, as opposed to competing if you're not just competing for some of the jobs, but all of the jobs, if you stop immigration at that level, then you'll have a housing disaster, and that happens for most economies. And most economies need to attract high-level people to bring new skill sets into countries. Whether that's the UK, whether it's Australia, whether it's America, everybody does it.
Sure.
I was going to say, touching more on the debt too. So, if you look through the cycle in 2008, or I guess the super cycle of debt that we've had, where the consumer racked up a bunch of debt, then the banks racked up a bunch of debt, the governments bailed out the banks, now the governments have a bunch of debt. Who bails out the governments? Or how does that
we've gone through
structure work?
Yeah, we've gone through this before in the past, and generally it always ends badly. When we went through this the first time around, it ended in, unfortunately, World War II. That was the end of World War I, where the debts got built up. But usually what happens is some sort of debt jubilee, which sounds like a nice, happy word. Let's have a jubilee. What it actually means is,
fun, yeah.
I'm not going to pay you back.
Well, right. Before we get a little bit too morose and depressed talking about no one's going to pay us back, we're going to take a brief break, and hopefully we'll re-energise ourselves with some optimistic thoughts. We can come back after the break and talk about some new topics. And in particular, I want to talk about some of the banking sector, because we talk about the debt market and, well, what does that mean for banks? And you've written I think it was in your most recent newsletter, that the banking sector you thought could see declines of 60, 70%. So perhaps we haven't quite solved the problem of optimism right here and now, but after the break we're going to have a focus on it. Welcome back. In the second half of today's show, we're going to continue our conversation with Raoul Pal about the economic risks facing investors and what to do about them. In the first half of the show, Raoul, we alluded to the fact that there might be some challenges ahead in the world, and one of the areas that we talked about was debt, and the fact that, and Neville, I think you hit the nail on the head with saying, look, we went through a crisis where there was too much debt from consumers, then there was too much debt for banks, and now there's too much debt for governments. And you'd written recently about the fact that you speculated that UK banks in particular, but I think you broadened it to other banks as well. You said that UK banks could be 60% overvalued. Now, anyone who's contemplating investing in stock markets, banks are a material part of stock markets. A decline of anywhere close to 50, 60% in the banking industry could be quite cataclysmic for stock markets in general. Can you explain why you were so anxious about banks, and what caused you to think this? So at least we can try and assuage some of the concerns that people might have hearing those numbers.
I thought this was supposed to be the optimistic section.
After we got rid of the...
This is.
Yes, the banking sector around the world didn't really clean up fully after 2008. And that's the problem, and we can see it in the European banks particularly. So the European banks in Italy and Spain and now Germany are basically been in free fall. Many of the shares have fallen 60% this year alone. Swiss banks like Credit Suisse, that's a big deal. that's another weird thing. We talked about how weird it is with the bond market at low yields and the equity market at all-time highs. Well, here's the banking sector been plummeting and the stock market at all-time highs. Something is giving you a signal and people aren't listening to it. The UK banks, there is an issue from Brexit. It really is a big issue. And the markets have brushed it off for the time being. The newspapers have brushed it off for the time being. But there's a massive issue with Brexit because people don't know. There is no surety if you're a corporation or a bank in England anymore, because right now there will be no agricultural policy, no agricultural subsidies, there is no health and safety, there is no all of the big things. There's no intellectual property rights. They're all European. Food and Drug Administration, all European. There's nothing. It has to be built from scratch. Also, the UK has to go out and negotiate trade deals. Trade negotiators are the toughest people on earth, and if they know you have a weakness, they will exploit it. The UK has a terrible weakness, is it's been booted out of Europe now. Now it said it wants to go. The Europeans are like, get out, get out, get out. And they have to now go and do trade deals. If I was the trade negotiator from the US or China, I would now know that the UK has to get these deals done quickly.
From a position of weakness.
So if they need to do it quickly, then what would I do? Drag it on as long as possible to get the best possible terms for myself. So that is a big concern for UK banks too. And the UK banks have similar issues. Bond yields are going to fall. Bond yields will probably go negative, as they have, which is something else that people should be very aware of. And that drives the banking sector further down. So it's complicated.
Let me just focus a little bit more on the banking sector, because I've heard the argument made, and I've heard the argument you're making from other commentators as well. And then I've heard the flip side of this argument, which is actually we're being far too pessimistic. And the argument goes something like this, which is, the banking industry was an industry of exuberance, growth, and all sorts of other excitement. In hindsight, a little bit too much excitement, one might argue. But actually nowadays, the banking industry is one, just like an electricity or gas or water utility. It is going to provide a core service, charge us a fee for that, and its return on capital is going to be low but much steadier. In that sort of environment, prices that banks are today, albeit materially lower, they may not have the same growth prospects, but banks are a different sort of vehicle than they were, and therefore they shouldn't be valued in the same sort of way that they were. Is that not a potentially countervailing, somewhat more optimistic perspective?
So, yes, that's certainly right. But what we need to figure out is which banks are still problematic versus which banks are good. So once you get that, you're right. There's a definancialization of the global economy going on, which is the flip side of the debt. So banks, as you suggest, got a little too big. Well, not a little too big.
Way too big.
Vastly too big. And
complicated, right?
Yes, and the financial economy was way too big versus the real economy. So that's correcting, and will correct probably over another decade or so. It took several decades, 20, 30 years to build up. So it'll take some further time to get rid of. So in that period, banks, as you say, many of the good banks will just trade like a utility, because they've been regulated out of existence in terms of speculative vehicles and all the other things that made them racy. So they're not. But the problem is, with a negative bond rate, it's very hard for banks to make any profits at all. So it's a bit complicated. The good banks will be fine. The bad banks probably need to actually be out of the system to clean the system up.
Something that's interesting about this, when you draw the analogy to what's going on in Cayman, is we've talked about banks being overly complicated and overly large. And it's interesting when you look around the landscape here, even in just the last 7 or 8 years, there are so many fewer banks today in Cayman operating than there were 7 or 8 years ago. And that's a symptom of, presumably that's a symptom of this over-complexity. And the way to reduce complexity is not to try and understand it, but actually just to close down those things which you just think you don't need. So there are many Swiss banks, there are many European banks, many UK banks, many American banks that no longer do business here in Cayman. And in fact, trying to open a bank account can often be quite a challenge here in this economy.
Yeah, that's right. I mean, people think of, externally think of Cayman as a offshore banking centre. I mean, as we all know, as you say, it's almost impossible to open a bank account. So it's not a banking centre at all. But yes, but it's better for a country like this to have fewer bank entrants. As long as the banks that are there are competitive in their pricing, then it's okay, because it's much easier to manage than having 58 banks. I mean, that's the problem with Italy. It's got literally thousands of banks, different banks. And Spain had the same problem. And, you can't keep your eye on all of this banking sector.
Yeah, it's interesting. It's interesting when you look at what, 10 years ago, what global banks, so HSBC, Citi, they were really trying to become global banks, kind of everything to everyone. Now it's much more of okay, what's core to us, what makes sense, and I think that's been a lot of the kind of retrenchment here in Cayman. And I would agree with your point about having fewer banks, but at the same time making sure those fewer banks actually provide the flow of capital required to actually do the business that Cayman has done.
Yeah.
So we did promise that we'd try to be a little bit more optimistic in the second half of today's show, and I have just returned from California, where everyone is perennially optimistic, perhaps over-optimistic in some respects. But looking at the California marketplace, people there don't seem to worry so much about these sorts of issues in the same way. They say, well, look, you can still raise $1 billion if you're an Uber or if you're whatever other sort of company it is. What's your perspective on that? Are we in this old economy, this old finance-driven economy? Are we just missing the plot and we're not really understanding what's going on in this new world of Twitter, WeChat, WhatsApp, and all these other things?
I spent a lot of time in California and
survived
and been in the banking industry for 26 years. I know hubris when I see it, and there's a lot of hubris because everybody thinks they're masters of the universe. When I started in the banking industry, I was working for Goldman Sachs, surrounded by ridiculously smart people. The finance industry was taking more scientists than the entire science industry or any university, anything. It sucked in all the capital. That's now all going to Silicon Valley and tech firms. Mm-hmm. Everyone's making crazy amounts of money. So we talked about the financialization of the global economy. That was the last wave. Now it's the technologicalization of whatever the word would be.
We coined a new word there.
Yeah, exactly. Is that technology thing is where everybody's piling into, and it's sucking the human capital into that. Mm. Now, the problem is there's an old-fashioned thing called a business model, and the business model generally means that you start a business to make profits. Twitter has never made a profit in its existence. I love Twitter, but that's not a business. To invest in something like Twitter, it's not a business, that's a charity. Charity is when you give away money, mm-hmm. and businesses are where you invest your money. So that is the problem. But if we want to talk about optimism, so if we step back about what we've been talking about with equity markets at all-time highs, bond yields too low to give you any income, real estate somewhat complicated, what should you be doing? What's the real answer? And the real answer is what's going on in Silicon Valley. Ignore the valuations. People are starting businesses. And everybody now can start a business. Now, this is the key thing, because to start businesses costs you sweat equity. You go out, start a business. I know that because I've just started a business. I've worked day and night to do this, to launch Real Vision. But with limited amounts of money you have to put into it, you can build a business that generates returns. Even if you start a sandwich shop and you get the right market and you do your marketing well and you do a good job with the sales and high quality foods, you can probably, if it costs you $20,000 to invest in, you could probably make $20,000 a year. That's 100% return on your investment. Why would you not do that? Why would you buy equity markets at all-time highs? I think, the days of lazy investing is finished, and the days of building businesses are here, and this is where the money's going to be made.
Your argument then, and before I assess the argument, your argument then is people need to learn perhaps to be more entrepreneurial as a way of delivering return on capital. You can address that in a second, but I can't let you mention Twitter without saying that MoneySense now has its own Twitter account, which is
right.
A development which has surprised all of the hosts, most particularly me. But we are, I think, MoneySense Radio. So if you want to Twitter us, or what is that a verb expression? Tweet us.
Tweet, yeah.
If you want to do something to us on Twitter, then find us on...
Yeah. At MoneySense.
MoneySense Radio, that's the one.
Yeah.
Something like that. So I think, Rahul, you're saying that people should learn to be more entrepreneurial as a way of delivering returns on their investment, actually do investments in, I guess a traditionalist would sort of call that private equity type of investing, finding businesses or developing a business. Is that kind of what you're saying?
Yeah, but not private equity, because stop giving money to other people necessarily and do things yourself. Because what you're doing when you buy equities is you're saying, well, I'm going to invest in them to run that business and deliver me returns. But if you're already investing your capital, you're probably smart enough to think about how I could start a business. Mm-hmm. Now, there is a failure rate, so fine. So you think of it in risk-adjusted terms, like a portfolio. How do you, what's the chance of failure? How much money do I invest in this? What does it take? Do that, and people will make much more money. And you know what? It's better for the global economy.
With one caveat, which is Elon Musk at least is trying to go to Mars, though. I mean, that's got to be a good charity to think about. So one of the other themes I wanted to ask you about, and you wrote about this as well, and I thought it was very interesting because it's an argument that was started off by a French economist about a year and a half, 2 years ago, who wrote a best-selling book about this, which was Thomas Piketty. The distribution of income. So there's a lot of concern nowadays when you look at politicians in the UK, politicians in France, politicians in the Netherlands, certain politicians in the US who are playing on this card of the 1% and the 0.1% and the fact that certain people don't have income. What's your perspective on this argument? How important do you think this is for where the future of our democracies are going to go?
That's a big question. I don't know if I've got time to address
and you've got exactly 2 minutes to answer it, so we'll have plenty of time.
Look, this income disparity is an enormous situation. It's built on many things. Part of them was what happened with the baby boomers going through their lifespan and how they distorted the global economy, how they didn't want to work. They wanted to just invest and hope, as opposed to saving, they could get their money back. So by giving it to somebody else to manage for them. So we distorted the global economy, and then something happened in 1996 was the World Trade Organization. Now I'm a capitalist guy. I've been in the hedge fund business, the finance business, but I saw an interview with James Goldsmith, used to be a famous financier from the 80s, and you can Google it. It's on Charlie Rose, and he explains in great detail why the WTO. He was prophetic. He was saying in advance of it why this would be terrible for places like America and Europe, that they would lose massive amounts of their manufacturing, and it would all go to China, and how you could get around that problem with tariffs and other bits and pieces. So it's too long a topic to talk about here, but yes, the income disparity is real. Populism in politics is a result of it. Mm-hmm. It's not going to get resolved unless somebody does something about it, or populism is going to get worse.
And you think that has an impact when you talk about the ways that one should think about investing? You think that's a corollary or a cause of that argument that you make? Invest in a business, start your own thing, as opposed to trust other people, because the system and the framework that you're used to, that you studied, doesn't really exist in the way that you thought it did exist.
I think the thing is, there's a big risk to the framework we understand as the financial system. We've talked about debt jubilees. We've talked about central bank manipulation. We don't see the outcome very clearly anymore. But build a business on whatever scale, whether it's a local store or a huge international business. Do that, and you're not involved in the stock markets. You're not involved in the bond markets. You're not involved in any of this. Central bank manipulations mean nothing to you. You just go out, sell your product, make some money, and make a good return.
It's more kind of local markets or stuff that you can control directly.
Yeah, exactly right.
I don't know. Was that ending on an optimistic tone or not?
Sounded like it.
We've got a former hedge fund manager who's saying avoid the markets and do your own thing, which is fabulous argument. I like it. So Raoul, our time is up, I'm afraid. But thank you very much for joining us. It's been a pleasure having you on the show.
Yeah.
Thanks very much, guys.
So as a final note before we leave, just want to thank all of our listeners and remind you that today's show will be able to be heard as a podcast on the CFA Society Cayman Islands webpage. Encourage you, if you have a question, to email us or tweet us. Is that the expression we use now? Our handle is @MoneySenseRadio. We do have our email address still, which is moneysense@candw.ky. So be sure to follow us on both of those. Email us, tweet us, whatever it is. With that, thank you once again. Goodbye, and please do tune in 2 weeks' time.
Thank you. Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.